we're going to cover today is we're going to talk about giving a presentation, a pitch to investors. And there's lots of different ways to do it, but there's one thing you take away from today's discussion. It's about telling a story. And like any story, you got to get them hooked at the very first page. I always relate it to like a John Grisham novel, because John Grisham novels tend to be, fun to listen to. And John Grisham novel, if it doesn't grab you in the first paragraph, you're not going to go to the next page and you won't read the book. So it's the same type of thing. So with that in mind, one of the things I will share with you is I've developed a sort of a methodology for people to think through from starting a company all the way to exit. And briefly to share that, and then we'll talk specifically about the pitch itself. I talk about the idea of the start itself, how to come up and think through the elements that make for a compelling startup. And then we talk about the market, and the customers, and the sales involved, the whole distribution element, and then building the team. And then today what we're going to discuss is the pitch, which also involves the structuring of the deal itself. From the legal standpoint, all the different terms involved and what some of the trade-offs are from a business perspective. The due diligence a lot of investors go through, and then when you talk about growing a company, the elements for growing a company. Metrics to think about, how to think about structuring the board, how to build the talent out, all the way to exit itself. So that's the whole idea of what I call from start to exit. Craft, fund, and grow. We're going to focus specifically today in the area of funding and specifically in the area of pitching. So with that in mind, first let me share one statistic that's interesting. People always ask me what makes a successful deal. And there's several elements, and there's been a lot of studies done on this. There's no question team is very important, and we'll come back to that in just in a moment. But the most important element, which is the hardest for investors, is the timing. So when you look at the timing of when a company is the right place at the right time. So let me give you an example. People talk about like Airbnb or Uber. The timing of that was very interesting. It was during the financial crisis of 08-09. And with that, people had housing issues and were concerned about losing their houses and thought, gee, if I can make some extra money from that. Or in the case of Uber, people were wondering, how do I get from here to there in a less expensive type of way and not have to necessarily own a car? So it rose out of the times it was in. And a lot of startups, that's what happens. It makes them compelling. So the key is hitting the right place, the right time. It's a confluence of the right technology being available, Moore's Law, global issues, perhaps it might play into it, but also macroeconomic. These are all factors in timing. And it's very hard to determine that when you're living it. In hindsight, it's always easy to go back and look at it, but at the time it's very difficult. So as much as you can, you want to think about that piece of the whole puzzle of when you're building a company, because that message, as we talk about the presentation in just a second, the pitch, needs to come through in a very real, sincere, compelling way. Now the team is very important, and we'll go through that in a little more detail too. The team isn't just, I've got my individuals, it's the right skills for what you're trying to do, the right domain knowledge, the right seasoning. It's not just the management team, but if you have any advisors of how they actually can bring value to it, it's thinking through the funding elements down the road, the type of investors you bring in. Certain investors can bring more value down the road than other investors. I've seen this over and over again. I've seen where it's actually people bring in $20 million, but at the end of the day, it was the wrong set of investors, and the company gets sold for a lot less than it could have been sold for if you had the right investors at the very beginning. So with that in mind, let's go forward. First, let me share with you some of the elements that I look for in terms of the team itself. Venture guys invest in teams. Ability to execute. And execution is a lot of different things. It's the ability to attract talent. It's the ability to actually grow the right pieces of the company at the right time. It is the ability to actually raise money. One of the things that's toughest for young CEOs to get a hold of is that it's about probably 60 or 70% of your job out of 120% is going to be raising money. And some people get tired through that process. But it's a very important element. And the ability to raise money can determine whether you're going to be a successful company or not. So it takes a lot of energy, and it takes a lot of chutzpah to do that. Domain knowledge. We talked about that just a few minutes ago. But it's having the right domain knowledge to what you're trying to do. And it's not just if you're looking at an e-commerce deal, this is a housing market. It's not just having knowledge about the housing market. It's deep experience in all the different value elements that go into, say, housing, the value chain of housing. whatever that might be, optimized around maybe what you're focused on, but you need to have deep knowledge. You want to be able to provide insight and communicate that when you go through your pitch to investors that shows that you've got a unique way of seeing things that other people don't. So past successes, no question, we all know that. Successes breed success. So that's one of the things that you want to be able to have, and you want a team that can communicate that, and also a team that is diverse in terms of that. Different types of successes that may have occurred in people. Ability to bring certain products out, having sold a company before, having raised capital, having built a company. Resilience and adaptability. This is one of the toughest ones. A lot of people enter gung-ho and excited, but once they're in the middle of it, sometimes that begins to weigh because of the energy involved. You've got to be resilient. You've got to be very adaptable. Yes, focused, but as things change, you need to focus and change. You need to change with those and be adaptable. Always looking at the market and where you're going, and is this and asking yourself a very simple question: is the solution I'm providing solving a compelling problem? And continue to ask that as you build the product out. And do people care about it? Integrity. One of the things, there's always a hollow charm. In fact, I was watching Better Call Saul last night, and it was talking about Saul Goodman, the rise of Saul Goodman, if you ever watched Breaking Bad. And one of the issues he hit, very good talker, very charming, but he was not sincere, and he got caught for that. So people can see through and see sincerity. So charm can be very hollow. So you've got to be yourself, but you've also got to have real belief in what you're doing. Thoughtfulness, which leads to that. So a good founding team and a good CEO is one that is coachable, and coachability doesn't mean that you take every piece of advice handed to you. It means you think about it. You're thoughtful about it. You're not defensive. This isn't about being defensive. I mean, you need to have the maturity inside to look beyond that. But it's really critical. And it becomes a huge red flag. In fact, I would say probably half the deals I've been involved in that failed were because the founding team was too arrogant in the process and thought they had all the answers. So it's a really important characteristic. So now let's get into a little more about the DNA of a pitch. We're going to walk through each one of these, and this kind of lays on top of what we just discussed. So I'm just going to kind of walk through these elements as we on the slide here. First, it needs to provide the presentation, the pitch itself, and we'll talk about the structure of that in just a moment, needs to provide a clear ring of truth so that when someone hears the presentation, they believe, gee, this makes sense. It's complete, it's thoughtful, it makes sense. It's about markets, not tech. Even in today's age, with all the sophistication people have and what they've heard, they still sometimes come in and want to pitch tech because it's like they're hiding behind it, like that's the answer. It's not about tech. I don't care about the tech as much as are you addressing a need in the marketplace. You need to provide a customer perspective use case. To the degree that you actually have case studies, it's always valid, but you need to validate what you're communicating based on customer data. I don't care if you're an e-commerce play or if you're a business, a B2B enterprise play. That's an important element. And metrics matter. The more you can communicate with numbers that are hard and real, specifically about you, the better off you are. You need to assemble the right relevant team for now. That may change over time. And people need to understand that when they come to the company. So things change as a function of the needs of the company and the marketplace itself, and where the company is as it grows and builds itself out. Going back to the other side of the coin, story. Valuation, which we can discuss some more, we can have some questions then a little later. People always ask me about value and how to think about it, and everybody wants a high value. That can be very negative. We'll discuss that a little bit. We're not so much going into the structuring tonight of the deal, because valuation is a very complicated discussion. But you don't want to overvalue the company, nor do you obviously want to undervalue the company when you're doing it. But the value of a company is based on the story that you tell and how compelling and convincing it is, and that you can execute off that story and are, along with the execution. How well you're executing that now, and where you are in that process of executing. That's actually where valuation comes. So mind the time. When you're given a pitch, I usually say plan on 20 minutes, which means a handful of slides. We can discuss how many. It can be as few as 8 or 10. It can be as many as 20, but you need to move quickly. If you have questions and it goes to 30 minutes or 40 minutes or an hour, fine. But you need to be able to move quickly through your presentation. Up front, provide context and relevancy. Give people a framework of where they're coming from. People will start talking about what they're doing, and I have no idea where they're coming from or the context. Give context very quickly so that people can plug into what you're talking about and how it's relevant. Sell, don't explain. You're in the process of selling your company to raise money. It's not necessarily about explaining. That's why I talk about storytelling. Focus, focus, focus. Obviously, you've heard that. But be adaptable in terms of how you think about it, because even as you're talking to investors, you can learn. And when you do talk and give these presentations, it's helpful to have more than one of you in the room. Have yourself, have somebody else. When you're talking, they're listening and taking notes. They're watching body language, they're watching responsiveness, etc. And by the way, if you don't catch the investor in the first 1 to 2 minutes of interest, you probably have lost them for the whole presentation. So you should be watching body language and feedback very quickly. Convey clear differentiators, how you're different. Everybody comes in and goes, we're a little better. When I look at investment, I'm like, can this disrupt what's going on? I've looked at investments that I get excited when I say this will disrupt what is out there right now. It will change the way it is. I hate to use the word disruption. It's overused a lot. But at the same time, will it change the way things are done? Tell a compelling, crisp, easy to read, repeatable story. And showing is better than telling. If you have show and tell, if you've got something that's real, show it. Make it quick, make it simple. We all in this country grew up doing show and tell. It's a powerful tool to communicate how things work. Cite reports, give credibility in your claims. Anything that helps support your view is important. Be crisp and clear on the go-to-market proposition. So the go-to-market is the toughest part of any startup. It's actually where everybody stumbles. People do not stumble building a product generally. They stumble in getting to the marketplace because it's a new market. It's selling, perhaps it's selling something different to the market. It's a different way of thinking about a product. And it could be changing the way people buy in a different way for whatever reason. So the go-to-market strategy is the toughest, and it's the toughest one as an investor to judge. So let's talk about structure of the presentation. There is no exact way to structure this. So I've put this together as a template, but it doesn't mean it can't change and move around a little bit. Let's walk through the broad stroke of what I'm talking about here. First is the intro. That's providing the context that we talked about earlier, very quick to the point. The team, relevant. I don't care about that you have an MBA from Stanford or a degree from MIT. I want to know the relevancy to the company in which you're building. So it needs to be relevant. It's not about degrees. It's not about papers written. It's not about patents that you've accomplished. It's what it is, skill set wise. It's relative to what you're doing right there and then. The opportunity. What is the opportunity you're going after? Is it really a problem? Do people really care about it? Is it significant enough? Can people understand that this problem exists and they can relate to what you're going to provide in the next part, which is the solution itself? Is this a solution that can provide something compelling in solving the problem, which the opportunity provides? And then competition. So competition relative to, competition is, I've had people, even today, they always come and say, well, we have no competitor. Everybody has a competitor about everything. A competitor is doing nothing. That's competition. So any alternative is competition. So you need to look at it. And it may not be a direct competitor today. It may be somebody down the road. It may be something being done that in 2 or 3 years ends up being a competitor to you. So you need to think broadly. And through that process, you can use a competitive discussion to talk about how you're unique and how you understand a marketplace. Because if you understand the competitive landscape or what is there and what's missing, then you have a better understanding domain-wise of what you're tackling. And then the business model, how's it going to make money? You know, you've got to communicate that. But a lot of businesses have started not knowing that. In fact, one that pops in my head is LinkedIn. I know Reid Hoffman, and when he started LinkedIn, which sold for $20+ billion to Microsoft, he had no idea how he was going to make money. Well, they overcame that. How did he overcome that? Because as he built users, he started asking and looking at what users wanted. And then he figured out how to monetize that as the user base grew. So that's okay, but have a thoughtful way you go about it. But at the end of the day, you've got to be able to answer the question, how are we going to make money? You can't force that solution sometimes. He didn't force it. It came out of the natural process as he built a user base in his case. And they ask. You need to ask. That means, we need this much money at this point for this reason. For that, we get to this milestone. That allows us to accomplish this. That allows us to move forward. Milestones are very, very critical, and we'll come back and discuss that in a few minutes. So at the end of the day, these are the fundamental elements in any pitch, whether it's 8 slides or 24 slides. And the level of detail is dependent on your type of company and what's occurring and what you need to communicate to get people through the process. But at the end of the day, this needs to be done in a story fashion. You're telling a story. So again, brief company, the team, directors, future hires, where you're going, the opportunity, state the problem, any demo that you can have, the competitive elements, how the market changes over time, how you make money, the distribution elements that might occur in this. Even if you don't understand it, it's your understanding at that point in time, because this could change. And the financials with the milestones. These are critical elements.
Next question, Robert.
Please.
So is this like a globally applicable model, or for Silicon Valley only applicable model?
Well, I can't speak to cultural differences. I think that whenever you tell a story, as human beings do, we all like a good beginning, a good middle, and a good ending. So storytelling is universal. This is done in a story fashion. Think of it as chapters in a book. So I would say on a universal basis this applies. But there may be tweaks because of cultural differences. Tweaks might be that the team element maybe comes at the end. There may be a change of order. But at the end of the day, you're telling a story. You spotted an opportunity, a compelling problem. You have a compelling solution. You're moving into a marketplace that may not be well defined or is defined. How you're going to be different, how you're going to compete, why my team is relevant to what the problem set is, and what it's going to take for me to get here to there. That's it. So when an investor looks at a deal, and you're sitting in front of an investor, and I'm thinking more of a venture investor, but the same thing with angel investors. In the venture world, your job is to invest money. That's what you get paid for. So as such, you see a lot of deals. As an angel investor, I'm not paid to invest. I invest when I see something I like. It's a whole different game. So as a venture guy and an angel guy, I've probably looked at 10,000 business plans in my life, roughly in that area. And as a venture guy, probably close to anywhere from 500 to 1,000 a year. So you're going to go through them very, very quickly. And deals come from people you know, relationships you have. So the most likely people to invest in you at the seed level are friends and family, because they know you, they believe in you, etc. The next people to talk to, angel-wise, would be people from that industry that can relate to the problems that you're solving and sharing why they would care in building that relationship. So investing is about a relationship building exercise. You can't expect to go in, meet someone, and they invest. It takes a long time to build that relationship. It can be weeks or months. It can be longer. It can be years. Sometimes I've looked at deals and only 2 years later did I invest. So it takes a while to build that relationship. But when you actually have a discussion with an investor, this is the typical process. They might look at 1,000 deals, and you might get 3 minutes worth of their time. It could be an email, it could be a phone call. It's short. That's the elevator pitch type element. We'll come back to that. And it's either it moves forward or no, it stops right there. And that's where a majority of deals go, very quickly. The next thing is, if there's an interest, tell me about it. I want to hear more. 30 minutes, walk me through what you're talking about, let me see if I understand. And then at that point, it could be in person, it could be on the phone. At that point, it's either move forward or pass, but more gracefully. So it's not investors will never, particularly venture investors, will never, maybe it comes from the Asian influence, but they'll never tell you no. And that's the biggest challenge. Because you either want to know yes or no at the end of the day. So even if you hear no, it doesn't mean no forever, it just means no now. And sometimes yes doesn't always mean yes too. So you got to be real careful to really read people. That's why I like to have someone else in the room with my companies that can be reading what's going on as the presentation's occurring. A longer meeting, 60 to 90 minutes in person, there's an understanding of what the company does, there's a lot more discussion to see how rich a knowledge set you have and how significant is this problem and your solution to it. It's just deeper, it's getting deeper. And it might be a no, but let's stay in touch. It might be a no, let me introduce you to somebody that might be more interested. Then there's a second meeting. In the case of the investor community, it may be with another partner. By the way, when you talk to, if you get to the point you're talking to venture capitalists, you're going to go usually through the associate route. That's a very painful route and usually doesn't accomplish a great deal. You really want to go through the partner route as much as possible. Meeting a partner is much more important because they have a responsibility as fiduciary to manage the fund, so they're the ones that make decisions. An associate ends up being a gatekeeper, and they're going to tend to be very careful about what they introduce to partnership because they're concerned about their rep overly. So you definitely want to try to work with the partners themselves. Second meeting, in this case, might be with an additional partner or additional person. Then you can get into serious due diligence, which can go for weeks sometimes. And even the legal aspect, more due diligence can come out of that process in terms of reps and warrants and other elements that occur as well too. So out of 10,000 deals, maybe one deal's done. And now that one deal's done, out of 20 deals in a venture fund, maybe one deal is a real big hit. So the numbers are really, really tough. So that's why doing your homework is so incredibly important, because that homework will hopefully make you, it's not about raising money. Your objective isn't raising money. That's just a way to get to your end. It's a means to an end. Your objective is to build a successful company. And I would argue, if you can do it without raising outside money, more power to you. Or if you can do it and prolong the process of raising outside money, more power to you. So this is a little bit of my background in terms of what I've done. I've done about, as was mentioned earlier, I've done a bunch of different deals. I was lucky to be in NVIDIA, which is now a very successful company. But I'll tell you, there's a couple of times in the process there were real question marks if they were going to make it. And now you're talking a company that's well over 150 billion. And tonight we're not talking about structural issues. If I was, I would be talking about the difference between convertible notes and equity, when you think about one versus the other, what the trade-offs are, and how each one of them has its own elements of thinking through. In fact, on Thursday, I'm going to touch upon, we're going to have a much more involved presentation. It's going to cover this briefly, but we're also going to go into, it's going to be very fast moving. I'm going to talk about some of the term sheet issues from a business perspective. They're legal terms, but I'll give you my perspective as an investor and what the trade-off is for the entrepreneur. So what liquidation preference can mean or not mean, or right of first refusal, or these different terms that come up. But we'll go through it quickly. That in itself is a very prolonged discussion, as I'm sure our local attorneys would agree. So what I'd like to do is, for those that have startups, I've handed out a worksheet here, and you're welcome to ask any questions. But if you're working on a startup right now, the idea is, whether you do it now or later, is to organize. If you haven't done it yet, but you're moving towards that direction, the first thing is the intro. Okay, in one sentence, what is the product or service you're providing? This goes to the elevator pitch. So the elevator pitch, if people aren't familiar with that term, came out of this discussion. If I was in the elevator with Warren Buffett, I don't know why Warren Buffett, because he's a value investor, not a growth investor. But if I was in the elevator with a really successful, investor, and I'm going up to the 15th floor or 10th floor, somewhere in that range, I've got like a minute or two to talk to them. But I got to get their interest, so they want to spend more time with me to find out what I'm doing. So that's what an elevator pitch is. So it's got to be very quick. You got like 1 minute or less. It's a hook. And it's got to be crisp, and you got to get, it goes to the same idea I've shared with you story-wise. It's a short story that's about what it is you're doing, the team that's involved, why anyone would care about this problem, and how you're solving in a compelling way, and it's got to grab people hard and fast. So when you think about the intro, that's what it is, because as I shared earlier, if you don't grab that audience quickly, you're going to lose them. And you'll tell. You're going to be able to tell once you've given this a number of times if you've lost the audience. You'll see them fade. They'll start looking at their phone. They'll look other places. So you lost them. Team. So the first thing is, think about that. That's the question to answer. This is, who are the team members you'd want to have in this core team? You don't have to put names on it in terms of this little worksheet. Who are the type skills that you need in terms of that? Whether you have it or not, it's a whole other issue. And the opportunity, what is it you're trying to really solve? So you just literally walk through this little worksheet to come up with a framework of what you would do in a presentation. And then from there, The idea is to build it out into a full presentation. But I found this to be very helpful, and I've given it to a lot of startups to think through when they're first developing their first presentation. And by the way, a presentation is a painful process. It's become what business plans used to be. So the process of doing this is easy, then you really haven't put enough energy into it, because it should be painful. It's a hard exercise to do it in a way that people care. So with that, any questions? You want to fill one out? I mean,
I have a question.
yeah. Well, go ahead first.
About the team.
Yes.
I have this idea, though none of my team members, we are 4 of us, have
Okay.
any domain knowledge of the problem that we are trying to solve. But we, or at least me, I strongly believe that there is a problem to be solved, worth solving, and there is nothing like it. Yes, I'm ready to shake hands and be partner with somebody who is domain expert. I'm still searching for him or looking for it, him or her, whoever. How important is that?
Well, it doesn't have to be day one, but I personally believe it's a really critical thing. But I'm going to give you an example of a story where it happened and you didn't have it. And you can relate to it. So it depends on the area too. So I was recently reading this story about how how Airbnb came together. And for those that don't know the story, it's interesting. A couple of young guys came to San Francisco. They didn't have housing, so they holed up together in an apartment. They didn't have the money to cover their rent, $1,000 a month. This is obviously several years ago. And so they go, how are we going to do this? And there was this conference coming in town. I don't know if it was like the sales.com event, but one of these events was coming to town. So a lot of people were going to be here and they needed housing. They said, well, why don't we just we'll rent it out and we'll do it where we provide breakfast and everything. Hence the term Airbnb. So it was air because it was just an open space. People slept on, literally had air mattresses, hence the air, that's where it came from. And then the B&B was bed and breakfast because they provided them breakfast before they went off the next day. And it worked out. And that's where the idea of Airbnb came from. Did they have any background in the hospitality industry? No. Did it create challenges? Yes. Did they eventually get that skill set? Probably as early as they could. Had they run into challenges in the marketplace? Because no question, as we all know. But their original idea was so compelling. Would that have worked years earlier, the timing issue? No. 5 years earlier, that idea might have caught on, but they were trying to maximize the income they could get off a piece of property they controlled. And so again, it goes back to timing. If you hit the timing right, then, and you really have a feel for the timing like these young folks did, then you might be able to escape the domain expertise, but you need to plug it in fairly quickly once you get going, and you need to make sure that you don't step on yourself in the process. Please.
I have 2 questions. So, how do you identify the size of the market? How do you calculate the market? Number one. Second, how do you create a business model that is a working business model? I know it's extremely challenging. This is number one challenge for all startups, to create a unique business model because everybody is like duplicating what everybody did. Everybody's trying to create a new Uber. So what are your tips? What would be a working business model for Silicon Valley investor, and how do you find it?
So first of all, you can come Thursday and you'll hear more about the elements. But in terms of the market size issue, that's always a difficult one, and people will slice the market up into the broad market down to the total accessible market, TAM. You have SAM, TAM, these different terms you've heard of before. At the end of the day, and don't try to buffalo, investors in terms of what it's, just get to the point of the market. So you're going to be a subset of some market, whatever it is. And it probably is not well defined, because if you've got something that's truly compelling and different, then maybe it's a new market or it's an emerging market. But you need to define it in such a way that people can get their hands around and go, that makes sense. It's like your forecasts on revenues. They're always going to be wrong. They're never going to be right. I've never seen a startup get it right. Sometimes I'm lucky and it's better than I thought. Generally not the case, but better, because entrepreneurs by nature are overly optimistic, which you need to be. But it's going to be wrong. So the key in market size is understand as best you can, but be pragmatic and real. So it's not a set of just numbers, it's understand the marketplace, hence part of the domain expertise of really trying to get down to what the addressable market is for what you're providing a solution for.
For example, market for Educational services is a global market for us. We know that everybody in the world wants to learn about innovation, right?
Yes.
How do we narrow down the market and say this is exactly our market? Well, how do we approach to like discover what exactly would be the market?
Well, and that's obviously changing too, because one of the things you would look at is innovation is causing people to look outside themselves more, and how much of that's reflected in how much they're actually looking outside them more. And then you have segments. You might have a corporate segment for corporations dealing with innovation and how they go about that process, including how venture investing might be a part of it. You've got entrepreneurism, which is a little more easier to find the number of startups out there and what they're doing. Those numbers are harder.
All the startups in the world, and that would be the market.
Well, but it's a subset of that, because there's people that are self-funded. They don't raise money outside. They've already got the mentor and coach. They've already raised capital, and they've got people there to coach them through the process. I would look at young startups that are actually out there and that are struggling to figure out how they actually can get themselves in a position to build and grow what they want to do company-wise. And that's a big number. In terms of business model can be very difficult, because that goes back to some domain knowledge a little bit, but business model is not always, you usually don't get it right the first time. I've never seen someone say, here's what we're going to do, we're going to price it this way, we're going to do it this way, and 2 years later they're doing something different. Even the most successful startups you read about, that's the case. They start one direction, but they're listening and studying what the market's telling them. So if they're getting feedback it's not working, they change, they respond to the marketplace. And that's a key element. But also, as you work with the marketplace, it helps you understand how the size of the market is too. So true size. So a lot of it is experimental, but you're trying to do it in a very tight, condensed format. That's why being a good observer and being insightful and thoughtful is so critical in the process. Yeah.
From your past experience, actually the question is about the market size.
Yeah.
So I'm sure you listen to so many pages and they talk about that market is huge. Usually,
why would anyone tell me the market's small and come talk to me, right?
so usually, how much do you believe? You usually discount by how much, like this 20-50%.
So let me talk about a few deals I've done of recent and how I looked at market size and what I thought about it, because each one of them is a different representation. So let me give you a case study. So one of them is a company that has an interface, a brain interface that allows you to connect, and by thought you can control any digital device. And it works. I've used it, it works. So you go, well, okay, what's a natural? And originally the fellow that started out doing it, PhD in neurosciences, he's one of the top neuroscientists in the country, great domain expertise, very knowledgeable, built this tech. It's being built out right now as we talk. When he started, he did it because his uncle had lost his leg, so he was thinking handicapped individuals. But he quickly learned, as much as that's a great, admirable market, it's not a big market, and it's a very limited market, and there's a lot of issues that go with it. But what's in a market that's experimental, that's huge and growing quickly? The gaming market. And in the gaming market, what's also occurring? Virtual reality, augmented reality. And then he looked at where in the world is that the leading. So China. In China, virtual reality, they have whole amusement parks where you go into these big boxes that are virtual reality, which we don't have here yet, and they play these virtual games. And so by thought, you can control the game. You can use your hands if you want, but you don't need to use your hands. Literally, you control the whole game just by thinking, I want to shoot this thing, I want to go to this room, I want to type this, I want to say this, whatever. Do it by thought. And so, how large is that market? Well, you can look at the virtual augmented reality market and try to size it, but then how many people care about it with using thought? Well, that's a new dimension to the whole idea of interfacing to a device. So it's very questionable. That to me goes back to timing. People feel they're very limited by the way they interface with devices these days. They're looking for more ways, emojis and things like that, to try to be more concise, or examples of that. Very different, but still examples of it. So he's pieced together what the market is, and there's also enterprise plays. Controlling, when I'm working on a Boeing engine, aircraft engine, the ability to flip through a manual and use my mind to flip to the manual while I'm using my hands and maybe zero in on a diagram while I'm using my hands in a noisy environment where talk can't work to work on the aircraft engine, but using my thoughts to go, okay, now what part do I need here, or what do I need to do here? And it can walk me through that just by using some thought. So he's had a number of enterprises, NASA, Boeing, a number of people approach him about using this tech. But he's also seeing applications that he never thought of. So the part of it is he couldn't size that market. He still doesn't fully know what it is. It's emerging. But he's got an idea of, if this tech is successful, what it can mean to certain industries and how it can change them. And he spent a lot of time talking to different players about what it means to them. Okay? Very different company. Software company. Guy provides software for part-time people. So there's a couple of interesting software companies we all know about today, SaaS companies like Workday, and they've been very successful in managing the whole idea of onboarding people when they join a company and things like that. But what this company does is they provide the ability, in the part-time, when 0809 happened, the workforce was about 30% part-time before that. When that happened, 0809, part-time, because people lost their jobs, went up to 60%. And guess what? It stayed at 60%. 60% today of the workforce is part-time. We know that people no longer have a tie into their company anymore, whether it's salary people or even hourly people. And he's focused on hourly. And in the case of hourly, they still want their flexibility. And they want to work maybe multiple places. So he's tapped into the ability that you can manage your schedule, get all the financial stuff you need from different players. So he's working with McDonald's, and in the case of McDonald's, if you become, if you've been certified to be a fry cook, and you go to another McDonald's, it already shows up. You're already certified. You don't have to prove it to them. So there's this whole element of certification and qualification that you can carry across different companies, and maybe apply it to something that's new. So I work at McDonald's, and now I'm going to be working in retail, and maybe there's some tie-in because I'm selling cookware, whatever. The point being is that he's developed a platform that's of tremendous interest to the people like McDonald's, because they have to manage their part-time workforce, and a tremendous people that could be college students or people that work on hourly basis of how they can actually have multiple options and figure out what they want to do. I got 10 hours this week to work. Where can I go work? And it provides that capability. Another company I'm involved in, I've always been interested in Africa, because it's an underserved market that's very tough, that we've never understood, and culturally very different than this country, as we all know. So this woman has developed an app kind of like QuickBooks, but it's all on an iPhone. So it's gamified, and it's got pieces that are free all the way up to paying, and it allows a small business first just to track the transactions, because guess what they do in Africa today? It's all pen and paper. It's all on a pencil, all of it, because they don't really have the computers. They do have smartphones, but they don't have the apps to support it. So first it tracks all the transactions of just buying and selling stuff. And then over time, she sees providing accounting, which allows them to go to a bank to get a loan, because right now they can't get a loan because it's all on paper and the bank can't analyze that. Plus, they can find ways to work together as a group, so like a co-op, to get purchasing power from certain buyers that common people might want. Like maybe people make donuts in 3 different cities, so they can all buy from the same flour manufacturer. Okay, so she's looking at gamifying something on an iPhone. That market she can define. There's so many people in that market, small businesses, and here's where it's going. So she can better define what that looks like. And certain types of small businesses align more to what she does. So that's a little easier to size up. So each of these are different. There is no one rule for all of them. That's just 3 examples.
And if they try to forecast their revenue, right? They just based on how many they can serve, I guess.
Well, yeah, she also, early on, it's painful to forecast revenues because people take longer to buy and make decisions than you think. I mean, when you change your way of doing things in your own lifestyle, think about something that involves a financial decision or involves changing the way you do stuff. You're not going to jump on it right away. Sometimes, yes, but generally it doesn't have a huge impact. But it has a huge impact in your life. You're going to take time. So now if I'm in Africa and now I've got to use my iPhone and it's going to help me, I'm like, yeah, this is exciting, but it means I got to do this and I got to do that. I got to change the way I do this. It takes a while to do that. Just like originally when Intuit started, it took a long time for people to start using Intuit. Start using not just QuickBooks, but the checking Quicken. You know, I was an early user of Quicken, but it was a slow process because it involved a change, even though it's checkbook registry format, which is the way we all think, it still took a while for people to accept that. It didn't happen overnight. By the way, Quicken had a hard time raising money. They went to 50 different venture guys and got turned by all of them down. Scott Cook eventually raised money from TVI, which is now gone. That firm is now partly Benchmark and partly August Capital. So staying with it and being tenacious is very critical. If you came to me at that point and said people will use software and I'm going to charge them only $25 because that's when software was $250, and that was one point, and they're going to use software to manage their checkbook, people would say, why? Right? So sometimes the things that don't make sense are actually incredibly compelling at the end of the day. Even Facebook, if you go back and look at that. Why would people want to put all their information on Facebook? And we're going back 20 years ago, right? So you have to look beyond yourself. So as a venture guy, I have to look beyond myself and what biases I carry and look broader. And that's the hardest thing an investor does. But if you can touch into that, if you can tie into that connection, that's critical. It's magic. And that can get it beyond the market size. Because then the investor might see elements of market size that you've never thought of. Maybe they see something you can learn from. Don't see an investor as money. It's a process of learning and coaching and getting something out of it. I just provided it for you as a tool that you can take away with you. If I were putting together a presentation to an investor right now, and I was at the very early stages of it, so I don't know where you guys are, I would use this as a starting template. It's just, if you can't answer these questions, then you got a long ways to go.
I'm sorry, Robert, I will ask many questions today because I have a pitch to do later this week, and I never did it in my life ever. So I'm very excited actually to learn from you. So about the ask, what are the things? What is the best way to ask for money?
So
how do you do this?
And how much?
Well, and that is what you need. Okay, so there are some rules of thumb about amount of money you raise at certain stages, broad rules of thumb. So ultimately, it's what your needs are in the business. So you need to communicate to me what you need and why you need it. And sometimes I go back and go, you need more. I'll give you an example of that in a second. But the ask is communicating, here's where I see how my business is going to build out. And I believe this is what it's going to look like based on market and whatever. But everybody knows you're wrong. That's okay. But what you're trying to communicate is your thoughtfulness and where you think the business is going to be. You need to think through the numbers even if they're wrong, because it shows that you're being thoughtful and you understand. We think we'll do this much in revenue and this is the reason why. We'll get these 3. If we can get a dozen customers the first year and we think we can get a dozen because we're talking to 6 right now and they might lead us to another 12. We think we'll close on this. That relates to this sort of revenue. Things like that. And with that, it's how much money it's going to take based on the build out of the team you need. And you want to be lean and mean, but how many people it's going to, what's your burn rate going to be? And usually in the case of like software companies, rule of thumb, software companies most people are, I don't know what the mix of people is in here in terms of what you're doing. Software, hardware, medical device? Software is that? So software companies become very efficient in raising capital. I mean, you don't need a lot of capital. It used to be you needed a lot. So whereas you used to need what in today's dollar would be $5 or $10 million to your Series A, you can get by with a $500,000 convertible note, maybe up to $1 million, maybe $1.5 million, depending on the market. And then we'll come back to what you got to generate milestone-wise to raise a significant round more for distribution and sales and growth. $5-10 million round then. So I've seen a lot of companies come to me and say, we're only going to raise $5 million now, we'll raise it later. So one of my companies, which is an energy SaaS company, they were going to raise $500,000. I said, that's a little light. That's not going to take you. That'll take you maybe 6 to 9 months. And I'm telling you, You think you're going to have paying revenue. They thought they already had a bunch of pilots going. They said, well, we'll convert these to paying revenue, and that'll help validate us, and it represents $500,000 in this time frame, and et cetera. And I said, that's all good, but it's going to take you longer than you think to get there. So raise $1 million. So they raised $1 million. And it was just as easy to raise $1 million as $500,000 in their case. So I have another company that raised $1.25 million, and I wish they'd raised $2 million. And I told them it's going to take them longer, and they're now stuck in an enterprise process where they've got customers that are going to buy, but it's going to take them longer to get to the purchasing decision. And it takes time. And you don't want to be raising money when you don't have money. That's the problem you are right now. If you're starting a company, you're raising money, no money. That's the biggest challenge. But once you raise money, you want to make sure you have money when you're raising the next round. So in the case of software companies, you've got to get to the point where you're doing at least $500,000 up to maybe $1.5 million. $1 million is what people call on a run rate basis. Maybe $1.5 million on a run rate basis to be able to raise a serious venture round today. And that's only if, and it's not just because you have, let's say you have $1.5 million of revenue that you have to show. It doesn't mean you're going to raise a venture round, because they're going to go through the same questions of, does anyone really care about this? Maybe it's only going to be a $10 or $20 million a year revenue company. Venture guys are looking for things that are hundreds of millions of dollars a year in revenue. But just because it's not a venture deal doesn't mean angels don't care, and it doesn't mean you can't make good money off of it. So small markets can work too. You just got to think about it differently. But when you go to the venture community itself, the formal community, you got to have revenues along that basis today.
How much you give up?
Well, there's lots of rules on that. First of all, it's market driven, supply and demand. Right now you have a situation, because the market's been pretty hot for 10 years now. You can argue when we're going to go into recession, and it also ties to the IPO market, et cetera. You could argue right now is more of a entrepreneur position. They're in a better position to ask for more valuation. Historically, I've always thought about you give about half the company when you raise your first money. Convertible note doesn't always work out that way. I would say you're going to give up anywhere from, if you're really raw, 50%. If you maybe 20, but at the other end of the extreme, maybe you only give up 25%. So the company that we just put $1 million into has got a $4 million valuation. So it ends up being 25%. Two of the companies, about 25% they gave up. And it's based on the fact that they already have trials. They have beta code. It's not production, but they've got trials going in qualified situations, and the feedback, albeit still kind of early, is very, very positive. And the more, it goes back to what I said, it's about the story, but it's about execution. The more you can show that you've executed, the more customers you can show, the more validation that people care, the more you can show that it's a big area you're going after, the more compelling what you have is, and the process is going to be so overwhelming, people are just going to gobble it up, the higher your valuation. It's oversimplified, but that's the best I can share on that.
How do startups calculate revenue? If there is like a formula or just basic kind of guideline to calculate your revenue?
Revenue is based on what you believe. I mean, so these software companies I'm referring to, it's what I sat down, I said, tell me who's in your sales pipe right now. Okay, and they said, well, these are guys that started with nothing. They worked on it in their basement for a couple of months, and they went and started talking on doors.
But if this is a prototype stage, if it is a prototype?
Still prototype. This was even before they had beta code. This was early code. They could show a storybook of what it was going to look like, and they'd say, here's what we're doing. What do you think? They got feedback. You need to do this. You need to do that. They went off and they wrote some code. It helps to have guys that can write code. They came back and they got feedback back and forth for 6 months to 9 months from there, and they put their own money into it, not a lot, maybe $50,000, $100,000. And then as they got those customers, they started appreciating how people might want to buy it, how they'd want to price, what the pricing would look like. And then early on, it's okay, how many of these do you think you're going to close the first year? What's your pipe look like? How's it growing? Because one customer can lead to another customer. You're talking to, I don't know, McDonald's, extreme example, obviously. You tell McDonald's, Burger King's right around the corner, right? I mean, that's a good one. But I mean, the point being, even if it's a small customer, same thing. So, and then it's like, okay, realistically, what do you think you can close and what does it look like? And this is where I find, and I'm repeating myself, people usually get that wrong. They're overly optimistic about what it is. I usually take that number and divide it by about 3 or 4 in my head. I don't tell them that. I don't want to take away from your enthusiasm, but that's what goes through my head.
What would be the difference between angel and venture pitch? Except
Not
from
really
how
much.
much money you ask.
Well, an angel pitch, and the way the market's evolved is, first of all, you don't want angels to price your round. You don't want to raise an equity round generally with angels, and I'll come back to why in a second. So the market's evolved where angel guys are providing what's called a convertible note. How many people know what a convertible note is in here? How many people don't know what a convertible note is? Let me ask it that way. So venture guys do equity rounds, preferred stock. So a convertible note is a note, which means it's a debt instrument. So debt is senior over equity. Okay, so they're first in line in case something goes wrong. But as a debt note, it's very simple to put together. I can write a debt note myself pretty quickly. You can execute it quickly. Their legal costs on, if you want a lawyer to look at, it's very low, maybe $1,000 or something, $2,000. Whereas an equity round, it's going to be $100,000 because it goes through a very formal process and beyond the scope of today's discussion. But a convertible note will convert into the equity round when the equity round occurs. So let's say you do $1 million convertible note, just to pick a number. It'll have an interest rate, might be small, might be 6% because it's a note. And by definition, to have a note, it has to have an interest rate, believe it or not. You also have SAFE. I'll touch upon that briefly. And I'll go into a little more detail on this on Thursday, by the way. So if you want to come back on Thursday because I got slides to share with this. Though we'll go quickly through it. So a note has certain rights to it that when it converts into the equity, it might be a cap, that it converts into a certain price. It might have a discount to the equity round because I, as a note holder, am taking more risk because I'm before the equity round. So I'm expecting you to accomplish something before you raise the equity. As I just remember shared on a software company, you need to be doing like $1 million run rate to raise a real venture equity round. And the reason why you want venture guys to price it and not angel guys, you want institutional investors who it's their job about pricing and valuation to price it. But as a note holder, I'm coming in early and taking more risk, so you better pay me for that. Hence, usually a discount. I get more stock when the equity round happens. There's different mechanisms that get kicked in a note that allows me to manage my risk. Because it's all about risk reward. If I take risk, I should have higher reward, right? And so that's what the whole process about venture investing involves. And again, we'll talk a little bit more about this on Thursday, albeit it'll be very quick. And that in itself is a long discussion. But so angel guys, it's the same presentation, but the mechanism is usually through a note. And also notes don't have to have one closing. You can raise money and raise it again and raise it again. But as you raise it, the original guys should have gotten the most discount because they're the ones that were in there first taking the most risk. Treat your investors well. Because some people don't. They think of them as like, I got to carry these investors along. Bad attitude. Because if you're successful, or even if you're not, those people are going to they might write your check next time. If they're successful, they'll fund you again, and maybe you won't take as much money from them because you're now wealthier, but still, you want to keep them happy. This is an important relationship. Don't piss all over it, which some people do.
I'm a little bit confused. Investors, like I got advice that I want people to invest that also will be willing to be in my board because then they care about the company, so they have a good contribution to the board. Angels, it's also the case?
Yeah, well, first of all, I as a shareholder always care about my companies, whether I'm on the board or not on the board. So I've been on the board of many companies over the years, also been an advisor. So with a board role, you usually get a little extra kicker in terms of stock as a board member because they're committing more time to it. Usually a board member is those putting in significant money in. So if you're raising a angel round of say $500,000 in convertible note and somebody writes a check for $200,000 of the $500,000, then they may want to be on the board, but the board changes at the equity round. So every time there's new money that comes in, the whole board can get restructured. That's fine. And I, as an angel guy, understand that. But he may want to be, or she may want to be in there early on the board to make sure they're, coaching-wise, they're giving you some good coaching along the way. And there's certain things you want to do governance-wise that help position you better for an equity round. minutes and some basic elements that are important to think through. But an investor relationship is very close. Some people say it's closer than a marriage. A marriage can get divorced. Once somebody invests in you, they're hooked. You're hooked. You can't get rid of them. So you better make sure the relationship is one that's meaningful, that you connect, you can get along, you trust them. We all learn about things, but that when that happens, you've got somebody there you can work with. And no one's perfect, but I've seen situations where the people are so hungry for money, they take the money, and this guy or she is just a charlatan and just cause lots of problems. In fact, it happens more than it doesn't happen.
Yeah, it was in the Silicon Valley TV series.
Well, it's real.
They got these rich guys that caused them a lot of problems.
Well, that's a very true story. I've seen a lot of them in my life. And it wasn't TV, it was reality.
Yeah, no, there were a lot of true stuff in this TV show. But with angels, usually they're also getting involved.
They might be involved in the board, early. So as an angel investor, I've been on many boards. But then as soon as the Series A comes in, some of the venture guys, I step off the board. I usually acknowledge that. I'll say, I'll step off the board when the Series A funding is. I'll help you get to the Series A. I'll help you raise it. I'll talk. Part of my role, if I take a board role, I got to work with the company in a pretty tight way. In the case of, I used to talk to the company once or twice a week when I was on the board. As an investor, I might talk to them, once a week or maybe 2 or 3 times a month. It's a different relationship. You can also have advisors. It doesn't mean that you can't have an investor as an advisor. Then there's no board role. So also when you have a board, there's a governance issues, and you have insurance that you're going to want to have there. It's not necessarily expensive, but you got to have a lawyer involved. You have E&O, errors and omission. You have D&O, which directors and officers, insurance. And if I'm on a board, I want to make sure it's in place. Because let's say you're selling a software product that optimizes signals for traffic through red lights and green lights, and all of a sudden your software gets hacked and goes bizarre and there's crashes all over the place. I don't want to be liable for that, right? Particularly if I have pockets, money, right? So, you need to have that in place if you go that direction. There's, a lot of people that raise angel rounds don't have a formal board really sometimes, and that can work as long as they're close to their investors and communicate on a regular basis what's going on. So there's lots of ways to handle it.
In case of angel investors, so do you have any rule of thumb, like how much it is compared to like round A money? It's like 10% of like what usually.
I'm missing what was your question again?
So the amount of money usually people get from angels until they get to round A. So how much it is?
Relative to what?
Like it's like $100,000 compared to $1 million. Like how?
It depends on your company. So an angel deal might be $50,000 or $100,000. The low end, it's not much money, but let's say 100. And the largest convertible note I would do would be, I've done one up to $2.5 million. And that's pretty large, because what happens is that note's got to be rolled into the equity round, and it's going to be dilutive to the other investors, and they get a little fussy about it if it's so big. Not that they won't accept it, but if you haven't accomplished enough with the milestones to generate the right value to the Series A investor, then it creates challenges with the convertible note. Do you follow what I'm saying a little bit? So you can argue what the max is, but I've seen 2.5, I've seen 3, which is really big. I think a convertible note, and software companies are pretty efficient, or software or service related. $1 million, $500,000 to $1 million. This company, I was telling the Brain Interface, I think we raised a little over 2, because they needed it, because there's more R&D involved. It's a lot of IP involved in what they're doing. So to get a product is a lot more than writing code. Code was just a piece of the whole thing, right? A lot of science behind what they're doing. So those are numbers, rough numbers.
Okay, so angel is usually like in the hundreds, thousands?
Hundreds. So, an angel investor might put in as little as 10,000 or as much as 100,000, maybe more depending on who it is. A lot of the angel deals, I was talking to 2 guys looking at 2 deals today, and they're looking at 25,000 from any angel investor. So, and I've done angel rounds as small as 5, and I've done angel rounds a lot larger than that.
How much equity do they want for like such a small amount, 100K? 1,000?
Well, it depends on what you're doing. Maybe you don't need much money. Maybe they've already got a customer set, and raising money is dilutive, even if it's a convertible
But you
note.
can give away equity for $1,000?
No, 100,000 would be a convertible note. So it has to convert, and the note usually has a term to it. Now, there's another mechanism. I didn't mention it. Beyond today, Thursday I'll go through it briefly, but it's SAFE. I don't like SAFE notes. You've heard of SAFE notes? So a SAFE note came out of Y Combinator. You know what Y Combinator is? So Y Combinator is an incubator. They created this thing with Wilson Sonsini called the SAFE note. I forget what it stands for. It's an acronym. It's not a note. They call it a note. It's not a note. So it's not a. So a convertible note, as I'm discussing it, is a financial instrument that's been recognized by law. It's been vetted through different legal things over the years. Courts of Delaware, which a lot of this stuff is done, or courts of California, when things occur. It also is a mechanism that if the note goes bad and the company goes bankrupt, you can write it off. It's a clear financial instrument, like an equity is a clear financial instrument, okay, or a savings account or a check. They're clear financial instruments. A SAFE note is not. It's a creation by lawyers. It's never been sanctioned by law, at least yet. And a lot of people use them because they're supposedly easier to put in place, but they have a lot of issues to them in my mind. So I won't go any further. But they're an alternative to a convertible note. I personally am not big on SAFE. But a convertible note itself usually has a term. It might be 18 months, which means in 18 months you need to pay it back, or you need to talk to the investors to roll it over, which typically happens sometimes. Maybe you might have to raise multiple convertible notes. Some people, it takes a while to get there. That's why you got to keep your investors happy and communicate. If I don't get an update like once a month from one of my companies, I'm not happy. I got one company, this guy's a horrible communicator, and I would never invest in him again just because of that alone. Doesn't communicate, that's not good.
What do you expect in terms of relationship with the startup?
Transparency and openness.
So except
Honesty.
from once a month communication, what else?
Yeah, it doesn't have to be long. It's like a one-page update. Here's what we did. Here's what happened the last month, either product development or revenue-wise or customers. Here's what we said we were going to do that we didn't do, or something like that. And here's what we're going to do next month. And here's maybe the issues we have. And here's maybe who. So it's something that's just boom to the boom to the boom, but it communicates. So I get a very quick picture of what's happening or not happening. I can sit there and mentally go, here's where I think they are. And maybe, I got one today, and maybe I call the entrepreneur up. I'm going to see this guy in a couple of weeks. He's in Boston. But I may say, his name is Rakeem. Hey, Rakeem, you said this. What did you really mean on that? Oh, and by the way, Rakeem, you said this. I think I might be able to help you. I might know someone that can help you with this issue. So by communicating, you get your shareholders to help you solve problems. What a marvelous idea.
Indeed. I heard, Robert, that angels are more motivated by an idea or impact and an interest in certain technology that is new, disruptive, while venture capitalists are more interested in numbers. They don't really care much where.
I don't know if I go that way. The problem is a lot of angel guys were successful entrepreneurs or made money somehow, and they started investing, so they don't really have an experience in investing. So I've met a lot of angel guys that don't know what the hell they're doing. And they're not very valuable. Venture guys have been doing it. It's an apprenticeship business. It's like learning how to, be a carpenter or make knives and swords or, armor. It takes a long time to learn, or make clocks or watches. It takes a long time to learn how to do that. Now, I can show you how to make a watch and you can start building it, but to be really good at it, it's going to take having done it a lot of times. And it's the same thing. So you really want investors that have been there and done it before. That also relates to relationships. If you've got someone that's never really done it, puts money in, they may be nervous all the time. You don't need them calling you every day or every other day. What's going on? What's happening? That's not productive. So, but good angel investors, if they've seasoned and been around the block, can be extremely valuable. They can lead you to venture guys because they have the relationships. They can give you coaching about this doesn't sound good or it does sound good. They can give you, you can use them as a mechanism for practice for things like a presentation. Venture guys, I don't know what numbers, ultimately depends on the venture guys. And there's some venture guys I wouldn't give 2 cents for one or two reasons. One, they don't have a lot of experience. Or two, because they're overly arrogant. And there's a lot of venture guys that are really arrogant too. There's no question. They're usually younger people because if you've been in the business long enough, You've lost enough money. You've lost money along the way because this is a hits business, and you get humbled.
In terms of personalities of the founders, because we heard many times it's also important. Imagine you have like 3 equally perfect pitch decks, but then like the difference would be the founder, right? So what are the things that you look at in terms of the person?
Well, it's the things I shared earlier. I mean, it's knowledge. It's the ability for them to pull a team together. So it's their teammates, the people that want to work for them. And one of the things I heard about this company, it's the paying company I told you about, the part-time software company, is that I heard, and I was in a meeting and I overheard it, and he didn't know I heard, the CEO didn't know I heard it, but what I heard was, oh man, I really like working for this guy. He's just great to work for. He's smart, and I'm listening to the side. And then I have another company that's in Boston, and eventually they're going to have to move here to have the better exit. So you go where the money is. I mean, the exits here for what they're doing are higher than they are now. They're in Boston. There's about 12 or 15 of them. And when he was looking to move to San Francisco, and he was looking at moving earlier this year, we held it off, mostly because of the cost of living here, is because he can get more bodies there for what he's doing. But when he was looking at moving, every single one of his team members from Boston was going to move here, even with a higher cost here. They want to follow him. They believe in him. He's an effective leader. He knows what he's doing. They believe. These are the people. These are people in their career, right? Now it helps that none of them were married, but still, actually 1 or 2 might be married, but still, that's incredibly. So that's what I want to hear: is people that want to follow a leader. And then raising money, because ultimately if you can't raise money, you've got no company. And if you're successful, you're going to have to raise money somehow. It's going to come.
Where do I go looking for angel investors?
Lots of sources. I mean, first you start with people you know. Friends and family are people in whatever you're doing. Let's say, this software paying company, he probably started talking to people that from Paychex and people in that industry that had built companies. So whoever is in your industry that has like an older generation of tech or understands something about what you're doing. Maybe it's selling hats, okay? That understands a lot about hat manufacturing. Go talk to them. And then from there you build out. And it's a relationship, it's a networking relationship building exercise. You can't expect it to happen that quick. It takes time. And if you try to shorten the process, you'll get burned. And you'll burn them. So it's a dating relationship. You go on a first date, it's a girl and you ask her to marry her, what's gonna happen? Probably scare the hell out of her, right? You gotta work on it for a while, right?
I'm not an expert in angels, but I know that there are also angel groups.
Yes, there are.
So
There's a
that's
bunch of
something
them.
Maybe you can also
Yeah.
Google. I'm not sure exactly what to
Meetups, maybe.
search.
But you want to have an intro to that group if you can. So there's the Band of Angels, which is the first real angel group. I actually run an angel group that's not here. It's in Houston, in which we've done deals up to 600,000, 100 to 600,000 into companies. There's a lot of angel groups in the Bay Area. I don't know them all anymore. There's probably dozens of, depending on what you're doing. There's some focus on healthcare, some on software. But the best way to get into it is somebody that's a member of that angel group to bring you in there to present, where they stand up and go, I don't know, what's your first name? Sid is, got this company. I think it's great. I'm looking to invest. And because they say I'm looking to invest, then he's going to have an audience.
In that whole process, when do I involve the attorneys?
To have a relationship with an attorney is useful. But a lot of attorneys, I don't want to speak for Stan back there, but a lot of attorneys will work with you and they won't charge you up front if they believe in what you're doing with the view that they'll get paid down the road when the money is raised. But you don't want to overuse that service because they keep track of that. And, every time you talk to them, the clock, there's a clock. So you want to be, but you still need that coaching. And so like when you do a convertible note, to go out, read about what a convertible, how it works, but you'd want to have an attorney maybe, provide you a template and maybe look over the final terms and condition. Maybe give you a little coaching about, this is a trade-off here and there. So that when it's done, if you did a convertible note, I'm just picking that, same thing applies on IP or anything else. IP is a whole nother subject, intellectual property. But just talking about a note, when it's done, that you feel comfortable was done correctly, and also that when you raise the equity round, you won't have problems. You don't want to create problems ahead of time.
And speaking of that, we have Stan Lewandowski here, who is our generous host today, who can help you with legal part of your convertible notes and all other legal issues.
Yeah, and so it's whether it's a convertible note or intellectual property, you need to make intellectual property if it's something profound to what you're providing. You want to make sure you're talking to an attorney to make sure that it's patentable or trademarked or whatever it is, and why. And you want to make sure they have an understanding so it can be thoughtfully done. So there's the pure legal element, but there's the business practice element too, to make sure that it fits within a business framework you're trying to accomplish. Do you see what I'm saying?
Yeah, I completely understand. I'm going to be asking a related question with different subject. So I'm going to the market, and there are going to be some registered users to my service that is online. Well, but I don't have, I have a company, X, for now that I have been running for 10 years, which is completely separate domain. It's a software consulting recruiting firm. And now I'm releasing this service under that umbrella right now.
You can spin it out later. You can assign the assets. That's not hard. You can form a new corporate entity, C Corp. You have to define the assets. An attorney would help you do that. You can roll them in there. If that's what you're asking, that's not hard to do.
That is one part of the question. The more important is you talked about having insurances and liabilities covered and whatnot, and I'm going to have these registered users for this service. Will that be covered? What happens when I spin it off? What happens to all those liabilities? They will be now covered under this.
Yeah, because you're transferring the assets. What you're doing, you're transferring the assets to the new corporation called ABC Corp. And so in that process, they're moving over. And that's got to be well defined so that I, as an investor, know that they're not commingled and that the company is what I think it is, that I'm investing in. It's got to be covered. But a lawyer can help you through that process in a way that's defined and creates that wall, so to speak. Stan, I don't know if you want to add anything to that. Maybe that's good enough for, yeah. So I guess he's happy with my answer.
How much does KNL Gates charge for a convertible notes consultation?
Really depends.
Depends on the complexity. So, anything else tonight?
Will we pitch? Will we pitch?
Are you ready to pitch?
Do you want to share your pitch?
Yeah, well, I can.
He
I
came
can
for that, I believe.
Improvise.
You're welcome to come up here and just walk us verbally through it. You wrote some stuff down? I'll be happy to go back and sit in your seat. That's okay. I'm going to go back and sit back here and watch.
And then give you feedback, right? What do you invest
Well,
in?
it's not perfect, but I mean, like, I restructured my everyday pitch at this point. So we'll do. So hi guys, my name is Mikita. Actually no. Hi guys, my name is Nick. I'm pitching in front of you on behalf of Applicature. So Applicature is boutique blockchain agency. I'm sure you heard a lot about blockchain in last couple months and year, I would say, about Bitcoin, Ethereum, and cryptocurrencies. So what we are doing, we are a boutique blockchain agency which is focused on development. But at the same time, like, we are doing consultancy for blockchain companies who are launching their ICOs. In many cases, it worked for last couple months and year, as well as we are doing custom blockchain solutions. So in custom blockchain solution, there are like many corporations who are found their huge opportunity, huge market in this area, and they want to be in blockchain because it's coming. It's the same as internet happened like in 2000s. Nobody believed it. It was a bubble. Then everyone lost a lot. So now it's a time to invest in blockchain, and we feel this market and opportunity. So we just want to engage with as many people as we can, so they start to build something on blockchain. And we are ready to help with our wonderful team, which is already 80 people. So we have 25 blockchain developers, 35 marketing team with excellent background with marketing, which are doing like content creation and different kind of marketing campaigns for roadshows. So what we are doing as a team, we are creating like marketing plan and sending those great startups and ideas with white papers created by us as a consultancy company to Silicon Valley and in roadshow all around the world. So we helping to set up the event and meet great investors as well as angels who are ready to invest in crypto startups with cryptocurrencies, with tokens, or as a VC for equity in blockchain startup with blockchain idea inside of their business, on blockchain business model, I would say. So another thing about our team, that our guys in consultancy team, not a huge department, but at the same time, like there are 5 guys who are ex-PwC guys, and they have really good knowledge on blockchain technology, as well as token economics, as well as blockchain architecture. So we see a huge opportunity in this market, and I even don't know how to count this $1 trillion, but it's probably trillions, because everything will be on blockchain in next 10 years. And as a proof of this, I would say like such companies as Amazon have their blockchain department, IBM already working with their blockchain private network, and Facebook, as we know, like they opened a new position on the head of business development and partnership in blockchain, Facebook blockchain project. Google Cloud, as I know, like they working on blockchain technology to integrate it with data storage and so on. So we propose a solution that we need to go to the market and see like if there are enough projects that want to integrate with blockchain solution, but at the same time, like we are ready to give our knowledge for application accelerator. So we are founding right now, like, and starting application blockchain accelerator, and which will provide like our knowledge as well as so how to launch an ICO, for example. So we made more than 25 ICOs in the last 3 years, as well as 30 plus custom blockchain solutions in the last 3 years. So it's one of their, well, I'm trying to say, but it's one of their best companies on the market and one of the biggest companies on the blockchain market. Our competitors already went to some pilots with some companies, but we still see like opportunity in this ICO and integration of custom blockchain solutions. So what we are looking for, it's we think like $500,000 for each idea to create, to wrap it up, to make solution, to make white paper business plan, and then went to the market and start to promote it and got some raised money. So in last 3 years we raised $250 million for our startups, and we made our fortune out of it too. But now we want to expand and looking for around $5 million to start accelerator with 10 projects.
Thank you.
Thank you.
Good job.
Thank you. Well,
I want to ask the audience. So now you're going to not just hear my feedback, you're going to at least get the judge by the group.
Okay.
So we don't have any scorecards here. So use your fingers. 10 meaning phenomenal, 1 meaning no. So I'm going to ask everybody to hold up their fingers, your own view of it. Okay, you give it 10, you give it 10. Huh? Okay. A 7? Is that what that is? That's a European 7. Oh, okay, that's an American 7. And you got an 8, and you got a 6, or you got a 7. And then what did you do? 8, okay. So
was it average?
well, the average sounds like it's around 9 or something.
Oh, wow.
Okay.
Thank you.
But I didn't rate it.
Yeah, well.
And I've invested before. Okay, so first of all, I commend you for coming up here and sharing. You shared a couple of interesting things, but you didn't get to the point. You didn't tell a tight, crisp story. So, no, I'm just going to give you the feedback. I know, like I said, I commend you for getting up here, so you don't need to, I'm just going to give you thoughts, okay? Sure. Take it to, I mean, sure, you'll be phenomenal next time. You're going to be a Grisham writer or your favorite writer. So one sentence, context. Most people know about blockchain, and you don't have to go through a lot of that, okay? One simple sentence, at least the group you're going to talk to. If they don't know about blockchain, you shouldn't be talking to them from an investment standpoint. You need to talk about who the team is and what the relevant skill set is, the top 3 or 4 people. My name is, I've worked on this project, they're all blockchain related. We delivered projects that generated this amount of revenue, specifics, okay? Opportunity. You talked about blockchain, that's like talking about the internet. I could replace the word blockchain for internet, and it's about the same. You know, internet was 20 years ago, internet this, internet that, internet, blockchain this, blockchain that. So you're not really telling me what the opportunity is. You haven't told me what problem you're solving other than blockchain's going to be everywhere, which investors know. I know blockchain's going to be pretty much, it's going to be just like the internet was, or as a mechanism for trust, because blockchain is a trust mechanism, right? So you need to talk about the opportunity specifically of what you're going to be solving right now. The solution for that, you talked about consultancy. Investors don't like, consulting businesses are tough because your intellectual property walks out the door every day. So ultimately you want to have solutions that reflect that skill set that you're going to develop. So where are you going to develop it? What's it going to look like? Specific, not the word blockchain, specifically what that looks like. Whatever it is. And then the competitive environment, you know, that's across the board as well too. I won't go into that. Business model, may not know the whole answer to that. You're providing consultancy. One of the things I did like that you shared, but you glossed over it in the middle of it. You talked about you had 80 professionals. I don't know what that means or doesn't mean, but that may be a meaningful number. You talked about raising $250 million in the past. I don't know what that means or doesn't mean. You talked about, I think, 30 projects. You gave some very specific numbers, but I didn't have the context for the numbers. So I don't know if they're meaningful or not meaningful. Maybe they're very meaningful. It caught my ear. I just didn't have the context. So that's my feedback. So work on it being shorter as well too. I've been very verbal, but shorten it. Do what you just said in 5 minutes or less, 4 or 5 minutes.
That's great.
Okay? Thank you.
That I didn't really get how much he asked for, like what you asked. I think you said like $500,000
Per project.
per project, because with 80 people in the team, the burning rate is way more than $500,000. So I'm missing some context, like how many projects maybe.
Yep.
So
That was kind of what I was touching upon. It was not clear at all. You didn't get the full context.
yeah, that's what
Agreed.
I was missing, exactly where it's going.
But we got to give you credit. What's your name?
Nick.
Mick? No, Nick. Nick with an N. We got to give Nick credit because you stood up here. So I gave you credit. You want to try? Go ahead.
And also the business model besides consulting, I'm not sure, maybe needs to be a little bit more specific.
Well, that's what I said, because consulting businesses don't get really funded very often. And they're project oriented, so you live off the projects themselves. But
We don't need funding for the business. We need funding for accelerator. So that was the thing. Because
okay, well that was not real
$5
clear.
million for 10 companies that we will accelerate with
I
our
see.
consultancy services.
I see. Not real clear. So really talking about building an incubator of some type around blockchain. That would have been your 1 minute. We're building an incubator that focuses on blockchain startups, and we have the right relationships and connections to pull the people in.
This perfect.
I don't know if it's perfect, but do you guys understand what that is?
Now you
Yeah,
know.
it was not clear.
It's a little clearer.
In the last 3 years, we made 25 ICOs for our clients, and they raised with our help 250,000.
Got it. But here's what I've learned in these games. If I don't understand it,
Yeah.
Also, you're talking to a venture investor, not a crypto investor.
Well,
That's the
it
difference.
doesn't make a difference. I looked at crypto deals. It doesn't make a difference what the It doesn't make a difference whether it's you're investing in snails or blockchain or the next pharmaceutical thing. You still have to plug these things together to give context.
Go.
Okay. The name
Can you
of
stand with Mission to Mars? I'm sorry.
okay.
Yes,
The
sir.
domain name that we have registered as of now is bizrealworth.com. So I don't know whether the name says it or not, but it is going to be a business valuation made simple and readily available and probably cheaper option to get their business valuation, and the reason behind the business valuation. And we're going to be targeting the small businesses first, or we have certain types of businesses we identified which are commonly traded entities in business world. So it's going to be like Zillow or Redfin of business. So you can just search any business, like you search a house given the address or in a given zip code and whatnot, and you will be able to see valuation for that business. And business valuation is a complex area. It can be multiple valuations, but we're going to show all, and we have some ideas. We have the prototype ready for a small market. The team, well, right now there are only developers and me who think there is a market for it. We're going to be hiring domain experts, especially when it comes to valuations. I'm talking to some M&A people who have worked in the mergers and acquisitions area, also people who have these firms which evaluate small businesses like convenience stores, gas stations, restaurants, and whatnot. And so I'm talking to those people to get on board. Opportunity. As I said, I think there is a opportunity for it, and then the size or the revenue. I'm trying to extrapolate from how Zillow and Redfin makes the revenue. I know my market is going to be smaller than that, but still I think if Zillow or Redfin are making $500 million in revenue from advertisers, solely through advertisers, I guess our company can make $100 million a year when it is fully blown and nationwide. Solution, like I said, similar website like Zillow and Redfin. Competition, well, one of the things that we're going to be doing out of this, if we start capturing all the data, eventually we'll have a bunch of data to really give out those analysis and where the market is trending, or why the comparables and whatnot, and so basically the reports and data. And right now in that area, also will be listing these, will be the listing service for the businesses as well. People, the target customers are buyers, sellers, and agents, and advertisers to generate the revenue. And the competition right now is something called IBS report. They give this kind of report, but they're not localized report. They are very high level report, geographically speaking. Then there is Business Buy Sell, which is a business listing website. There is BizBang, again a business listing. LoopNet, which is actually CRE, commercial real estate website, and that kind of gives the comparables. So that is a competition. We are trying to get into that area as well eventually. Business models and the revenue, buyers, sellers, agents, advertisers. Buyers, sellers would mostly be free unless they want some intelligence or some detailed reports. Agents, it will be packaged as Zillow and Redfin packages for the real estate agents today. Advertisers, bankers, financing or creditors, their advertisements. Merger and acquisition firms, they probably will get special access or special report. The ask, I'm looking for, and this is ever evolving. I have really not worked on these numbers, but $2 million for 2 years, and we'll have a full-blown solution ready. That's what I'm thinking.
Thank you, Sid. Okay, let's do the same thing with Sid. You guys can judge me later too, so it's not like we're all fair game. Okay, hands. How many hands up? Okay, I got 7 there, 4, and I got 7 here. Got 5, got 6. Okay, so that was interesting. What Sid did do right, which is helpful, and you could probably do the same thing with what you did. He said it's basically Zillow for small businesses, which everybody would get like that, the valuation element. What he missed on was a couple things. One is when you finally said, you didn't say liquor stores, but but I'm thinking businesses that are bigger, somebody that has a chain of auto parts stores or something like that, and that's probably not even a fair play. The challenge is if you focus on individual businesses, you might be able to pull that off. It's going to be challenging to do something that's of a level of complexity above that, because you can get the information. You've got the property, if they own the property, whatever. So I'm being a little long-winded about this, but I would tie it, make sure you define what a small business is. I would also be able to give some specific examples of the type businesses. And I think when you look at because the reason why Zillow works on valuation is because they have comparables. And so you need comparables. And what are the comparables based on? Square footage, location, how many bedrooms. There's, a dozen, whatever different factors that go into valuation. The same thing probably applies, and you need to identify what those are. You'll say it, we've identified 15 of the parameters to define how a Utotem or a 7-Eleven is valued, just to pick an example. So crisp and to the point would be very helpful. I don't know what competition's out there. I got to believe there is. So you need to talk about that in a way of how you're better and different than it in the process. So those are just a couple of quick caveats. And as you can tell when you're up here, it's easy to wonder. And I know you're just on a spar. So, go in front of the mirror. Go in front of your spouse, your girlfriend, whatever, and practice. And try it over and over again. And the way this is the ultimate test. If your grandmother's still around, go give it to your grandmother. Because if your grandmother, gets it and goes, oh, that sounds pretty damn cool, I got it, I'm interested. And I'm not saying just because you're the grandson or granddaughter, but do they really get it? Then you got something. If your grandmother goes, what are you talking about?
But grandmother
That's a bad sign.
doesn't know usually what is a blockchain.
Well, but see, you can talk about blockchain differently. You can just know. So I gave a summary, and you could say blockchain is a new technology. I know you don't know what blockchain is, Grandma. It's a way to make sure that trust occurs across two parties, and it guarantees trust and transparency in the process. And think about it now, Grandma, when you go to a bank, that's one of the issues that's come up is the trust that happens, or when you buy something online, if she knows how to buy online. So you can explain it in simple words. Blockchain is just a technology implementation to allow it to occur. That's all it is. That's why it's going to be everywhere. It's going to be like the internet. It's not going to be a company. It's going to be a technology that's used by everything, just like HTML is.
Mm-hmm. So,
And in many cases, grandmother are accredited investors.
Here's another good point.
Silicon Valley, maybe. So I have a question.
And then we need to wrap up. We got one last question here. Go ahead.
So usually where we struggle with a lot is competition. Because if I just do something like an additional Lyft or Uber, everyone know who is my competitors. But if I'm inventing something new,
Yep.
so how I define how usually the competition.
Give me a 10-word definition of what you're doing. What's the sentence that says what you're doing?
Okay, so
10 words or a dozen, short.
okay. We use technology, a proprietary technology to help blind people to travel in public transportation.
Okay. So I don't know all the competitors to it, but there are competitors. There's probably some sort of mapping software that talks to people that are blind when they travel. There's probably other things out there. Those are your competitors.
So in our case, for example, the competitors are the transit companies, like
Perhaps.
that give a special right for these people with disabilities.
But you're providing an end-to-end solution. They're just providing one component for a solution.
But in our case, we provide a solution for them to ride fixed routes, like regular buses, and the competitors is just they cannot use a fixed route, they use the alternative way, like Uber or...
Sure.
So these are... It's not like our competitors because we develop
it's an
something that
alternative.
adds on the regular fixed route company. It's not like we do the company for the bus.
But but it's an alternative, and an alternative is a competitor. It may not be a direct competitor, but it's a competitor because if I'm blind, I may use Uber because I know how to use it, and it's there versus your solution. So it's an alternative. In some cases, it may be direct, and in some cases, Uber may be just an alternative. So you have to look at all those pieces and then understand where you are uniquely in the universe and what you bring value-wise versus each one of them, each category of player, like an Uber-type player versus a bus versus a whatever. You need to think about what you bring that's unique versus each one, and then the question is the overall uniqueness across the whole spectrum that I, as a blind person, go, this is great. I want to use this instead of this. So that's what you have to think through. But you do have competitors.
Yeah, no, I'm sure everyone has competitors, but it's not always very clear.
It's not always clear. No, sure. Uber had competitors when they started, cab companies. But it's clear how that played out. We all know how that sort of played out. Uber became easy to use. One of the other things to think about in terms of your case is why did Uber sort of succeed versus the cab companies? One is I have a universal way, no matter where I am, to get transportation, to enter where I'm going to go without even having to talk to the person driving me if I don't want to, versus getting in a cab and tell them, and then I got to pay them. So I've gotten into a frictionless environment. So Uber provided something with very low friction versus the cab companies at a lower price. And now I can tier, if I want a Uber X or non-Uber X. So in your case, those are some of the things that you would want to think through. How do you make sure it's low friction? Because if I'm a blind person, you got to make it really easy for me to use.
In our case, our customers are not the blind people because they get the service for free. Our customers are the bus companies.
Okay.
So we compete with other services that the bus company.
Then you need to think through why a bus company, would want to pick you versus something else. Maybe it's one stop and you can solve multiple problems versus somebody else only solves part of the problem, whatever.
Yeah.
And again, it's beyond today's discussion.
About this, and it's also
Yeah.
a perception of the bus company,
Yeah.
which not always is monetary measure.
And so the bus company, as much as your customer can tell you how they think about the competition versus you, use them as a way to understand the market and as a way to understand the competitive landscape by having discussions. Because if you go to investors at some point, they want to know that you've had a lot of discussions with bus companies, for example.
Actually, I also have good news. We just got our first paying customers.
Fantastic. Fantastic.
So, and it's a big check. So
Good. Well, you're off.
So that's really good. So, but this kind of pitching for investors, that's what we are learning.
Yes. So that's the next stage for you. And actually, whether you talk to investors or not, a pitch deck is helpful because it helps you distill down your thinking into a framework. And I've learned in life, when you write something down, it becomes real. When you don't write it down, it's not real.
Right.
Think about everything you've ever written down. It has some sense of reality that comes to bear down the road. If it's not, it's just a thought in the head. So writing it down, and that's just a framework of how to do it. Okay, guys, thank you so much. Appreciate the time.
Thank you, Robert.
Thank you.